Kathy, thank you very much for being on the podcast.
My pleasure. Thank you.
You're very well known in the personal finance world, and you wrote several books, and you've been a contributor to business publications such as Bloomberg, Financial Times, Kiplinger of Personal Finance, and you're the owner, right, and the editor of the Sidehusl, the website.
Yes, I am.
Tell
Go
us a
ahead.
little bit about it.
Well, Sidehusl is an independent review site of ways to make money in the gig economy. And so essentially what we do is research, review, and rate more than 300, actually almost 350 different online platforms that try to help you either work or rent or sell your assets. And so we review the ones like Uber and Lyft, Postmates, Instacart, etc., but also probably a zillion different opportunities that you've never heard of. And to me, the interesting thing has always been that the ones you've never heard of are probably the better opportunities,
Mhm.
um, and they're the ones that pay better, that have better terms, all that other stuff. I kind of feel like Uber, Lyft, Postmates, etc. They spend all their money on marketing, and they probably would do so much better if they just spend some of their money just paying the people better. The people who work for them
Yeah.
better. Uh,
That's fantastic because we're gonna come back to it, but the discussion today is going to be focused on the people who make money through gig economy and freelancers because over the past probably decade there's been a rise of it, right? And
yeah.
one thing that I'm concerned with is these people don't have the same access to financial instruments that traditional big corporation have, and those corporation offer to their employees. So I'm wondering, what are some must-have financial instruments for these people in order to build their wealth or at least take care of their retirement and children's education and any day-to-day expenses going forward.
Yeah, I mean, the big thing if you're a freelancer is you need to have an emergency fund. I can't emphasize that enough. And I think the pandemic has brought that home to people like nothing ever before has been able to. The thing about being freelance is that you go from feast to famine all the time, right? And it's just a normal uh, way that freelance work works. When I first went freelance more than 10 years ago, um, I would have months where I would be making way more than I earned as an employee. But then, the next month you didn't know. And there was, and so you just have to always have a cushion. And so, I mean, this isn't, rocket science. It's just have a bank account where you get high interest checking, even because you don't even need to put this in a CD. You just need savings, and then you need some sort of a retirement account. And the great thing about being self-employed is you actually have more options with retirement accounts than you do when you're employed. And that's because you're on your own. I mean, the great thing about being employed is most big employers will match your 401k contributions. And often that match is, I mean, incredibly generous, like 25% of what you put in, they put in. And so your money automatically grows by that amount. And that's before you earn interest on it or you earn investment returns. I always recommend to people that they set up a basic account at Vanguard. You need a couple $1,000s to do it. You can invest in one of their all around sort of funds that is going to diversify your assets for you. Something like the Star Fund, which also has a low investment minimum, which is great. Or you could invest in a target date fund. Or if you're young, you can just put money in the total market or US stock market index, which is a great index fund. And it tends to do better than the Standard and Poor's 500 because it's a more diversified fund. It has about 3,600 different stocks in it, and they go from really big companies to really small companies. awesome way to diversify your assets in US stocks. As you develop, or as you grow your portfolio and have more money, then add in a international fund and add in a REIT fund. REIT stands for Real Estate Investment Trust. And what is good about having that in your portfolio overall is, like international funds, they don't move all at the same time. So these are still kind of volatile assets, but weirdly, by putting these three volatile assets, domestic stocks, international stocks, and REITs in a portfolio, it actually reduces the overall volatility of your portfolio because they tend to move at different times. And so REITs being underlying by real estate assets and rents just don't function in the same way that normal stocks do. And so, and in fact, most of the return you get from a real estate investment trust is from the dividend, which is from rents. With everything, you have to keep in mind that when you're investing for the long term. When you're saving for any period of time that you're saving for. But when you're investing, think of it as 10 years or more. So these are things for retirement, for your kids' college, if they're small, all that stuff. And just don't look too often, because the markets do this and it will make you crazy and you'll think, oh, I need to do something. No, the smartest thing to do 90% of the time is nothing at all. Just keep on adding money. If the market goes down, that's a great time to add more money to your investments. It feels awful, but it's really smart.
I wanted to kind of dive into a few things that you mentioned. You mentioned the emergency fund. How do you quantify that? How much should be the emergency fund?
Yeah, it's different for everybody. You have to take a look at your own situation and how risky is your life. When I was married and my husband had a very stable job, and I had a very stable job, and we it saved a lot of money. We're living on much less than we earned. You don't need really an emergency fund at all, because if one of you kept your job, you were fine. So you both have to be out of work, and then you would have to have a really bad stock market so that you couldn't take money out of them. So there were a lot of things that would have to go wrong for that to be a problem. But then when I went into business for myself, and I'm now divorced, I'm earning my own money. Now, all of a sudden, I needed a lot of emergency savings because my risks were much different. And so when I started freelance, I had 2 years worth of cash available to it tide me over. And I kept that for about 6 months until I realized that my freelance life was going pretty well and I didn't need that much. And so then I reduced it to a year's worth of, emergency money. And now I'm, I don't know, 3 to 6 months of emergency money, because you better manage, or you're able to better manage your risk based on what's been going on. And so, but I think that's kind of the range. It's like 0 to 2 years is about what I think, because my theory with the 2 years was that if I can't make something else happen in 2 years, or I can support myself, well, there's something seriously wrong with my life.
Yeah.
So.
And just to clarify, those emergency fund and it's separate from investment funds, right? You
Yeah,
have to keep it on savings account, most likely.
essentially you need to have liquid cash
Mm-hmm.
available to you. And I always tell people, kind of go through the very unpleasant process of figuring out what could go wrong in your life. And now, how would I handle that? And everybody's got a lot of different levers to pull. I mean, like, when I was young, if everything went wrong in my life, I could move back in with mom and dad. And so, you have that lever to pull. You might not want to, but you can, right? And I think that's what you need to do at every stage in your life. What would I do if the worst happened? If my working spouse died? If um, it, I lost my job, he lost his job, like what would I do? Major medical, do we have enough insurance? If we hit the limit on our deductible, would we be able to afford that? Those are all the things you have to kind of mentally walk your way through and say, okay, what would I do here? What would I do there? They're not all going to happen at the same time. So you take the worst case scenario and account for that, like figure out, do I need savings for that? Do I need insurance for that? How would I handle it? And it what this process is supposed to do, besides helping you decide what the right pot of money is it should also make you calm in those, because you've already intellectually gone through the worst that could happen. And so you have kind of a plan. And I think that's something that people underestimate. If you've thought through this stuff, then it's not as much of an emergency, because you have someplace to go. And what you don't want to do is have this thing happen and have your heart start pumping and you panic in anything. I mean, going in any direction, panic is not your friend. And so if you thought through this stuff, not only to help you again figure out the right amount of savings, but also to figure out, okay, what are all the things I can do? It's not the end of the world. It's a bad time, but it's not.
Let's dive in a little bit more in this, and let's use this example. Let's say it's a single person who is a Uber driver, and this person already followed your advice. He or she has several months worth of emergency funds, and now he or she needs to think of what next. Is it the pension, or just grow its investments? How should this person think of building the wealth?
Yeah, I think that you should think about uh, doing a couple of things at the same time. So if you've already got an emergency fund, awesome, you're got a good start. Now think about uh, contributing to a retirement plan, but also if you have any, paying off your debt. Both of those are really important over the long run. The less debt you have, the less money you have to earn. And so that is an overall benefit. It will make it easier for you to have to retire when you want to, because really how much you need in retirement is a function of how much you spend when you're not retired, and the lifestyle that you've gotten yourself accustomed to. And so if the lifestyle that you've gotten yourself accustomed to is less costly, because you're saving a lot of the money that you earn instead of spending every dime, you will find that retiring becomes a piece of cake. And that is also, I mean, I actually have no desire to actually ever retire, because I love what I do, but I have always wanted the luxury of being able to retire. Like this not notion that if I don't want to work next week, I don't have to work next week. And that is that, and to me, that was a better luxury than a new car, a boat. I don't want any of those things. I want that luxury of saying, if I don't like my boss, I'm out of here, and that is to me, I mean, it's all about, to me, freedom. And so the more that you have saved and invested, the freer you become. You do not have to be shackled to a job you don't like, to an investment program you don't like. You don't have to be shackled to anything. You have the ability to walk away from the parts of your life that you don't like. And I think that that's incredibly important.
Would you start with paying off the debt, or would you split your income between, like, your extra cash between retirement, I don't know, maybe some other investment account and debt? What's your approach?
It always depends on how much debt you have, how high rate the debt is. So if you have credit card bills and it's at 22%, that makes debt a much bigger priority than if you have a home mortgage at 3% or a student debt at 3% or 4%. Those those I'm not going to prioritize of paying off because I know I can actually earn more than that over time in the stock market. I mean, if you look at the stock market over long periods of time, the average annual return for big company stocks is about 10%. That's a really good return. So if you've got a 3% debt and the potential to make 10% over a longer period of time, I'm going to prioritize that. If, however, you find if your debt is crushing you, then obviously that makes the debt a different animal. It makes it a bigger priority. But generally speaking, it's an interest rate differential. I look at, again, at home mortgage rates right now are so low, it's kind of silly. And I was just talking to my son about this, and I was saying, okay, so I don't have to have a mortgage loan, but I do have a mortgage loan because it's at 2.875, and there's just no way over time I'm not going to do better than that in stocks. And so, everything is relative, right? And my mortgage loan is tax deductible. So, I mean, the actual rate is maybe 2.5%. So it's like, yeah, I am not paying off that loan. I'm just not. I mean, it's fixed rate. If I have that loan when I die, good. But yeah, in the meantime, yeah, I'm earning way more than that on the amount of money that I would otherwise use to pay off that debt. So you look at everything relatively, and I think that it helps you understand the stock market and the bond markets, the financial markets, if you look at it as somebody is walking into the market with a fistful of cash every day. Now, what is the best thing to do with that fistful of cash? Do you invest in bonds? Do you invest in stocks? Do you invest in savings accounts? Real estate? You have these options, right? And all of the time, the markets are moving. So when bonds are at 8% or are going to pay a coupon of 8%, all of a sudden stocks don't look that good. Why? Because they're not guaranteed. The bond is guaranteed. So then you put your money over at the bonds. If, the same thing, it just, everything is relative. Right now, I think because interest rates are so low, it's hard to argue against investing in stocks, but you really should be diversified, not only among domestic stocks, but also have a lot of international stocks. So yeah, I have about half of my portfolio in international stocks right now.
I want to follow up on the retirement account.
Yeah, what type of account to open?
Here you go, yes.
Well, you have a bunch of options. You can open a regular IRA, which is tax deductible when you put the money in, but you pay tax when you take the money out. You can open a Roth IRA where you use after-tax money to put the money in, but when you take the money out, it's going to be completely tax-free. Or you can do a 401k, and you have the same sort of choices with the 401k. And the only difference between the IRA and the 401k, 401k has a little bit more reporting requirements, or you could do a KEO account if you're self-employed. But the simplest one is the IRA, and we'll just look at Roth versus regular or traditional IRA. And so the Roth, again, you don't get a deduction for putting the money in, but you don't pay tax when it comes out. The traditional IRA, you get the deduction for however much you put in, and you pay tax when you come out. Which one do you choose? That depends on how much you're earning right now. So if you are a high earning person, you use the traditional IRA because you can use that deduction to reduce your tax by whatever your tax rate is on that. If you're not earning that much right now, but you expect to earn more in the future, you put your money in the Roth IRA because comparatively, you're not getting that much of a deduction now, not getting that much of a break now. But someday when you're wealthy because you were smart enough to save young, then you're going to get a big benefit on the back end by not having to pay tax on it.
So gig workers should probably focus on Roth IRA because
If you're young and you're not earning a lot, yes. If you earn less than $50,000 a year, you pay very little federal income tax. And so that is the type of person who there's really no benefit to getting that tax benefit or the tax deduction. So use the Roth. If you earn more than $50,000 a year, now you start looking at the traditional IRA and how much of a benefit it will give you.
Got it. So, and that IRA, I can find it at Vanguard and some other dishonest
Almost,
brokers, right?
yes, almost anybody will open an IRA for you. Even your bank. Don't open an IRA at the bank. They have really bad investment choices. Yeah, open at Vanguard, T. Rowe Price, Fidelity, one of the mutual fund companies that has a good mix of index funds. And I'm going to really emphasize index funds for a simple reason. They have very low fees. And fees are one of the most important things that you will find affect your return in a diversified stock fund. So I did the math at one point on if you were investing, $90,000 in a fund that charged you 2% of your assets every year versus 0.2%, which is what an index fund is going to charge you. Actually, they charge less now. Over a 20-year period of time, that difference added up to $500,000. $500,000. That's just fees. It's just astounding, right? And so you need to be really cognizant of those fees. To me, if you're going to pay somebody that kind of money, they need to do more for me than invest my money. They need to take out my trash, watch my children,
And they underperform indexes anyway. So I guess we don't even include that, right?
The performance of index funds has been extraordinary. And, when I was writing for Kiplinger, I actually did a demonstration project where I took $200,000 of my own money and invested it. I invested a piece in an index fund in Vanguard Total Market Index fund, and then I invested the rest in individual stocks. And the idea was to see whether somebody who I wrote Investing 101, I'm actually pretty good at investing. Can I beat the market? And first of all, I will say the Vanguard Total Market Index is the toughest index to beat. But I failed miserably. And I think that that's very common, that in reality, the number of fund managers who beat the index are few and far between. And the ones who can beat the index consistently over time are almost non-existent. And so, yeah, the index is really good choice, a really good choice.
Great. So let's just summarize for what we got so far. As a gig worker, and this is let's say it's my full-time job, I saved the emergency fund, and I most likely open the Roth IRA at Vanguard, right? Yeah. Now, within this Roth IRA, I can actually choose the allocation of my assets, right? And
yes.
Would you choose between several asset classes? You mentioned earlier REIT, international, and stocks, depending on how much money you already accumulated, right? At what point would you think it makes sense to start diversifying into other assets?
There are a couple of triggers. The first trigger is age. So when you're in your 20s, you can be completely invested in stocks, 100%, because you have so long to let the market do whatever it does. And over time, you will find that that's the best asset class for somebody who's got decades to wait. When you're in your 30s, now you might want to start diversifying a little bit. 40s, 50s, I think it starts being really important when you're in your 50s and 60s to have some assets that are less volatile than the stock market assets. And so I have I wrote a book called Investing 101. And when we revised that book a few years ago, we did a chapter specifically on the lazy person's guide to investing their assets. And it just gave you like, I'm that lazy person. So what I end up doing is really having my money divided into three categories outside of my emergency fund. So your emergency fund, that can be your bond portfolio, or it is whatever part of your portfolio is really steady, right? So you can have it in bonds to some degree, you can have it in money market accounts and savings accounts, whatever. So that's the steady money, right? And as you get older, what you want to do is, instead of thinking of it as an emergency fund, because you have fewer emergencies as you get older, you start looking at that as your cash for living, right? So I don't want to take money out of stocks yet. This is the money that's going to fund the gap between how much I earn and how much I spend, or between my pension and how much I spend. So that portion is in these safe things. And then outside of that, I have my money divided between domestic stocks, international stocks, and real estate investment trusts. And I have them all in Vanguard index funds for those three things. And I don't need to do anything else. That's it. That's done. Like, you're allocated. You don't even have to think about it. Occasionally you look at your portfolio and you make sure that it's meeting your asset or your goals. And then what I've done, because I'm getting older and I'm, heading toward a point where I might retire. I actually probably won't, but whatever. It's theory. And instead of having dividends reinvested, what I do is I have them pay the dividends in cash. And so then, instead of having to constantly, if I spend this money, I have to sell something in order to refund or refill that basket of safe assets, it does it automatically for me. It just, pay the dividends into cash, and then it automatically refills that spending bucket. So
got it. I think I missed the share of each international, domestic, and REITs. Is it 33% each, or you?
I am skewed toward international stocks right now. And so I have probably 50% of my assets in international. And then I would say another 30 perhaps in domestic stocks, and then the rest in REITs and cash. And I used to be more skewed toward REITs, but the pandemic is really bad for rents. And so when things, again, it's that everything is relative thing. And so with things being what they are, I thought, not as much in real estate right now.
Got it. And most of this is in indexes or in actual individual stocks?
Index funds. Yeah,
Gotcha.
absolutely. Most in index funds. Yeah. And just one last thing to throw in on the REITs too. Realize that you also have, real estate is essentially a commodity, right? And so it's a different asset class. If you own your own home, you already have some of that commodity. So when you're looking at how to allocate your assets well, look at the equity that you also have built up in your home, and just keep that in mind. You're not necessarily going to sell your house, but you can refinance it to get cash out of it if you need to. You can do a reverse mortgage when you get older, but that you have that very stable asset, and so you can take a little bit more risk than people think, because you do have that. And Social Security and pensions are very much the same. That is the fixed income portion of your portfolio. And so as you get closer to retirement, you can consider that almost like having money in a money market fund. If it's absolutely safe, which I think Social Security and most pensions are, that's the portion that's already going to come from a safe asset. So you can take a little bit more risk with these other things.
And I believe there is a rule that if you withdraw funds from Roth IRA before a certain age, there's going to be a penalty. Can you elaborate on that a little bit?
If you withdraw funds from an IRA before 59 and a half, there can be a penalty. A Roth IRA, you can take out your principal as long as you've had it in there for more than 5 years and not pay a penalty. With a traditional IRA, you typically pay a penalty. There are ways to get around that, however. So if you're 50 years old, let's say, and you decide you want to retire, you can avoid the penalty by taking the money out ratably. So essentially, you divvy it up over your lifespan and take out just that amount of money for each, year, each month, and that gets you out of the penalty. But you can't just grab that money and use it to buy a house or use it to buy, pay for college without paying a 10%. You pay tax at your regular income tax rate plus a 10% penalty. And so that ends up being a very expensive way to go.
So let's just talk about somebody who is in a younger spectrum and a gig worker, right? I've met very few people who are like at their 20s think about their retirement. So to them, being 59, like most of them don't even think that far away, right? So every single person, including myself, when I was younger, I thought, okay, I'm 22 now, or whatever. When I'm 59, I'm gonna be multi-billionaire, blah 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 blah. Like everybody's, and statistics are against that, right?
Mm.
But how should this person think of balance between how much this person would have at 59 years old, right?
Uh-huh.
When he or she can access that money that they accumulate up to that point, and something in between. Like if this person is 35 and he or she wants to start a business, is there a way for this person to kind of grow some sort of funds to use it for the business? What's the
Yeah.
alternative?
Well, I mean, I think that what you do is, first of all, instead of thinking of it as retirement, you should think of it as freedom. This is my freedom fund,
Mm-hmm.
and just put that money away. And it does give you freedom, even if you don't tap it. One of the things that I like to emphasize to people who are in their 20s is, you know, a lot of things are going to happen when you're 30 and 40, and you're going to want to be you want to have freedom for those things. And so if you start saving when you're 20 for retirement, and then at 30, you have children, you want to stay home with them for a while, you want to travel with them, you want to do something that is not in the beaten path. Well, stop saving for retirement. Now just do your thing. And because you saved early, that money is still going to accumulate at compound interest, and you're going to actually have more than you think. Because really, the starting early is the most important thing you can do, right? And but because you've started early, you can put that aside and you can say, okay, all I'm going to be worried about right now is raising my children, and or traveling, doing this thing that I don't think I'm going to have another opportunity to do, and and you don't have to save any money then, and so that gives you a lot of freedom. And then obviously, if you're really smart, and because I always think when you first get out of college, everybody's poor, right? I mean, nobody has any money. We're all like living in our parents' basements or whatever, and and that's just the way it is. And all your friends are poor, and so great, act like you're poor for another couple of years, and put money in a retirement account and put money in a normal index fund savings account, or like a normal index fund that doesn't have a retirement wrapper. So all a retirement account is a wrapper around whatever investment you put in it. But if you invest in an index fund, you don't really need the wrapper that much, because all the wrapper does is if you trade, it saves you from paying tax on each time you make a profit. And it also saves the dividend income from being taxed on a real-time basis. If you invest in an index fund, you only get about 2% of your return or about 2% of the assets are returned to you in dividends each year. That's a relatively small amount. You can pay tax on that as you go. And to have this available to you. So for instance, if you want to invest in index funds and 10 years later you say, you know what, I am now ready to buy a house. It's time. You can sell that index fund and you can use the proceeds to buy that house. You have access to, or if you say, I just love to travel. I want to go somewhere and like explore the world. You can use that money and because you don't have a distinct goal for it, it's not your emergency fund, it's additional savings. You can keep it in an asset like stocks that will appreciate faster but are volatile. Because why you don't keep your rent money in stocks is because the landlord is not going to go, oh, it's a bad market. Oh, that's okay. You don't have to pay me this month, right? But if you have a bad market and you want to travel, you can say, I'll wait a few months. I'll wait until this bear market is over and then I'll travel. It's not going to ruin your life, right? It's not going to jeopardize the roof over your head. So that being the case, you can invest in those more volatile assets. But it's great to have both. So I recommend to everybody to have both retirement savings and non-retirement savings. And again, you don't think of it as, oh, I've got this retirement money. This is, for when I'm old. No, this is your freedom money. And you use it as you go along for the things that are precious to you. Money is just a tool. And you have to always remember there's no reward for accumulating more money than everybody else. The reward comes from recognizing money as a tool and using it to make the rest of your life what you want it to be, because that's what it does for you. It gives you freedom. It gives you security. It gives you the ability to raise your children where you want to, the way you want to. Gives you the ability to have, one of the ways I spend my money is I bought a house that I could entertain in, because I have 22 first cousins and I love them. And I loved having them all over with their families and everything. And so I wanted a house where I could have a whole bunch of people here. And that was precious to me, is precious to me. And that's what you use your money for. I mean, you don't win by dying with the most assets. In my opinion, if I die with a lot of money, I have failed. I've completely failed at life. Really. At some point, you should be like looking at how much do I need to live the life I want and live that life. And then if you have more than you need, then start giving it to people. I mean, I've told my kids, I hope not to leave them a big inheritance. I hope that I'm going to give them, the money to help them buy a house and to help them pay for their kids' schooling and all those other. I hope I'm going to do that while I'm alive, because what I want is to see the joy and to experience it with them, instead of them when I die going, yeah, I'm going to miss her, but I love that Jaguar. Like, I just got a Mercedes. Woohoo! No, I don't want my kids to be like, yeah, mom finally kicked off.
Yeah. Yeah. And one other thing I wanted to chat with you, you mentioned earlier the education expenses, right? So I think there is a plan for education expenses that people can also contribute to.
Yes.
What was the name? 529 or something like that?
Yes, 529 plan.
Tell us a little bit about that.
Well, they're a tax-free savings. So you generally put money in after tax. There's no deduction for putting money. The weird thing about 529s is they vary a little bit. State law handles them a little bit differently in every state, but federal law, you don't get a tax deduction for putting money in, but you don't pay tax on the money coming out as long as it's used for higher education. And you can use that for any type of higher education, even though you may put it in an account meant for your child, if that child doesn't end up going to college, you can transfer the money to another child or to yourself if you want to go back to school. And it, like a regular IRA, if you end up using it for something else, then you pay tax on it. But that's a relatively small disadvantage. If you have the money to put money in a 529, it can be a smart thing to do if you know that you're going to have kids who want to go to college. You can, however, the benefit is not as great as it is for stuff like a tax deductible 401k or IRA. And so if you're not certain, just put the money in a taxable index fund, just a normal index fund, and you're not going to be paying too much more in tax on that, and you have a lot more freedom with that money.
That's helpful. And lastly, you mentioned in the very beginning that you might be aware of some side hustles that people can leverage to perhaps earn that extra money that they're going to put in these investment accounts. Can you share a little bit about that?
Yeah, I mean, well, like I said, I run sidehusl.com, and it's SIDEHUSL.com. And we have research rated and reviewed about 325 different online platforms that allow you to make money. Some of them are awesome. There are wonderful tutoring platforms and teaching platforms where you do not need to be an educator, but you can earn $20 to $40 an hour easily. There are moving platforms where you can earn easily $30 to $75 an hour, helping people move their assets. There are a couple of alternatives to, there's a company called Dumpling that is an alternative to Lyft, Uber, and Instacart. And what it does is it helps you set yourself up in business, doing grocery shopping or driving for people. And they charge a very low fee. So you can actually charge your customers less than an Uber or Lyft driver and still earn more than an Uber or Lyft driver. And the thing that they don't do is help you find the clients. So you have to kind of find those clients on your own, but it's a great way to go. There's an app called Rover, which is a dog watching site. And they let you set your own rates and your own terms. So you set up a little profile on there and you say, yeah, I will watch your poodles. And I charge $25 a night or $50 a night, whatever you want it to be. And I've talked to people who turned that into a full-time job. Several people actually who make $60,000, $70,000 a year just watching dogs. Yeah, and it's such a, I mean, if you have the space for it, it's such a, and you like animals, obviously. It's such a low maintenance side hustle. I just love that one. And then there are a zillion that are for professionals. What we do on our site is we break everything into whether you want to work, rent, or sell. And if under the work options, we have 44 different work categories, from accounting to insurance to miscellaneous, which is where we put things like cuddling. You probably didn't know that you can make $40 an hour hugging people because,
Really?
yeah, yeah, I would not lie about that. I was, as a mom, I was a little bit concerned. It's like, okay, who's going to pay you to hug them for, $40 an hour? I want to know what's going on with that one. But yeah, but this actually exists, right? And then
what's the name of that app?
there's actually several of them.
Really? Wow.
Go to Side Hustle, and Companionship is what that's under.
Oh,
Yeah.
okay.
Yeah, it's very weird. Yeah, there's a site called Rent a Friend that also, this is not cuddling. This is like, if you need somebody to go to the movies with you, you're embarrassed to go alone, you're new in town, you can hire a friend, okay? Who knew? Who knew? Yeah, but that's, I mean, like I said, when you have hundreds of these opportunities, you realize that the options are huge. There are also some, which I love because I also like to cook. You can cook for other people, and you can have people in your home, or you can have you can cook for pickup, and you set your own rates. You decide when you're going to do it. You know, it's all up to you, and it's just kind of a fun notion, right? You can rent your house out by the hour. Why would people rent your house by the hour? Don't go into the gutter here. Um, it's for photographers
Oh,
and
okay,
movie
okay.
producers. Yes. And so let's say you have a really beautiful garden. They will rent your house by the hour. I have done it because this sounded too good to be true. I tested it myself, right? And I've now on several occasions rented my house out for events. And the first one I made $1,455 for one day. One day. Yeah, and you're like, whoa, what? Yeah, and you can make more. And this is just was a one day thing, and you can rent your swimming pool, you can rent your parking space, you can. I mean, there's a vast array of opportunities if you have assets to rent them out. Some things you don't get enough to make it worth your time, but if you have a decent home where you can entertain, like I do, um, like this is right now an extremely lucrative thing because micro weddings are becoming a giant thing because of course because of the pandemic people have had to cancel their weddings, postpone. They keep on thinking, oh well, you know, maybe next month they'll be able to have the wedding, and when they have realized that okay, this is not going away anytime soon, now they're just revising their plans, and instead of having the 200-person wedding, they're saying, no, I'm going to have our immediate families. There's 25 of us. We need to find a venue. And they're doing backyard weddings and backyard receptions. And you can earn easily $1,000 a day and making your home available for this. And what's cool is, well, you need to have everything clean and sanitized before they come in. You can charge a sanitation fee for when they leave, but you can also expect them to have everything cleaned up. You know, so essentially, when I've done this, I have somebody come in and sanitize everything before and after, but they're taking away all their junk. They're any time that they need to set up or break down and clean up, that's all. They're still paying you by the hour, and so the hours that your house is in use it's being paid for. And again, it's an extraordinarily lucrative side hustle.
That's remarkable. I'm definitely gonna leave the link to the side hustle in the description of the video so people can check it out. And I'm myself gonna check it out now with more interest. Yeah, I looked at that, but I didn't get to the point where I can hug people and get money for that. It's I don't know. I'm down. Well,
Good.
Katie, thank you very much for your time. I really appreciate it and all the advice you provided.
It's
And
a delight. Thank you so much.